Welcome back to Off Market. Today we're joined by Elijah Turkovic, a Queensland-based property developer who's built a $25 billion property portfolio before the age of 30. Elijah has been investing in property for more than 10 years and now focuses on identifying and developing large-scale land subdivision projects across southeast Queensland through his companies. Elijah, thank you for joining us.
No worries. Thanks for having me.
Can you take us back to the start? How did you first get into property investing?
So I got into property investing when I was about 19 years old, when I went out and I purchased a block of land. And my first investment was actually a build. So I went and built my first house. And I suppose that all really came about from me being much younger and always wanting to get into property as soon as possible because I knew it was my way out of the 9 to 5 grind, I suppose you could say. Yeah, so it started, almost 10 years ago, and because I've just turned 30.
So for me, it was my parents. My parents were somewhat, my mentors when it comes to the property space. I've seen them buy commercial, buy investments, buy obviously their own home, and I could see what returns they gained from it. Who was your mentor?
So for me, I mean, look, in a way it was my parents, but in the opposite effects because we grew up quite poor. So both my parents, we were mainly brought up on Centrelink and whatnot. So seeing what my parents did and how they operated was a bit of a learning curve for what I did not want to do. And look, I had a great childhood and I had a great upbringing, but both my parents were very academically qualified. Between them both, they've probably got, almost 5 or 6 degrees. My mum just finished her PhD in law. So both extremely academically qualified, but when it came to money, it just did not convert to money. And so growing up from a younger age, it sort of instilled in me that university and even just the traditional schooling route might not be the way to get to financial freedom. Now, that's not necessarily true. University has its very good merits. It's a very good thing to do, especially depending on what career path you want to do. But for me personally, it was instilling something in me where I'm like, okay, well, if I go down this route, the same route as my parents, my, I suppose, life and also my future family's life could end up in this trajectory. And that's just something that I just did not want to go down. So I would see how my parents would operate and the things that they would do. And it sort of steered me in a way that I needed another way to create financial wealth and freedom because although I did have a great childhood, obviously there's some caveats to having no money, going to school, on the bare minimum, living paycheck to paycheck. And that was just something that I did not want to do in, my future life. So I suppose the motivation or mentors and things like that really just came from struggling. So I realized what I didn't want in life and the life that I did want to have. And I wasn't going to stop at all until I got there. And I really think that that is such a big thing because a lot of people don't have that. I feel like it's a superpower. Whereas if you're given stuff in life or if you're shown the correct way to create money or if you're given a career path, that's amazing and you might go down that route. But when you compare it to, I suppose, someone with the drive of, never having something or desiring something or not knowing if you could achieve something, that really can be a superpower. And that's what I've really used to sort of fast track my career. And that's what I'm sort of bringing it all back to. But that was the primary driver was I knew property was my way out. I didn't know how. I just knew that it was probably one of the quickest and easiest ways to create wealth. And that coupled with my childhood was a big driving factor just to get into it as soon as possible and start building that career, whatever it may have looked like, as soon as possible. And that started, at that 19 or 20-year-old mark.
That blows me away, Elijah. 19 or 20-year-old mark. Most 20-year-olds is not even thinking about investing or property. They're probably still trying to work out in terms of their career path, what they want to do. How was it for you in your 20s, separating yourselves from mates potentially? I'm not too sure what your mates were like in terms of your party life, but how was it for you to separate yourself? Were you still doing things? Were you able to do things? How was it?
Yeah, I was just a normal, 19, 20-year-old, but I just had that, I suppose, idea in the back of my mind that I knew property was a quick and easy way to create wealth. And I always knew that from a younger age. That was the primary thing. And so I knew if I just put some money aside and I saved some money, which I did, I saved about, $80,000 up to buy that first property. I was saving every dollar and cent that I had. That would allow me to get into property. But in the sense of like what I was doing and who I was just like any other kid. It's just more so that in the back of my mind, while I was still doing just everyday things, I was saving for that first property. And all my money was going into that because while I was living just a very, mediocre, normal life, I was like, I don't want to continue living like this. So there must be some game plan. There must be some strategy in place so I can get out of this. Otherwise, I'm going to be in a position where, like I was in my childhood, with no money, and I'll be in the same position that I just will not accept. And I think that's a big thing that I think a lot of people struggle with, which is, how do they get into the property market? How do they start? And it really is as simple as just having a simple goal of even just saving up a deposit. And that first property doesn't need to be anything flash, but having that goal from when I was, say, about 15 or 16 when I first started working, at Domino's, and consecutively saving up until I was about 20, and I had that $80,000 to go buy that first property. Although that was a very minuscule and almost unmeaningful thing at the time, that was the first step to me really creating wealth and really working my way out of, I suppose, the 9 to 5 grind and not having any wealth. So I was, a very normal kid. I just sort of had this burning desire that I wanted more out of life.
What drew you to land and subdivision rather than a traditional buy and hold?
Yeah, well, look, when I started out as well, I was in that same mindset just to buy and hold. There's so much information out there, and then you follow, depending who you follow on Instagram, everyone's got their own investment strategy, and property, when it really comes down to it, can be a confusing thing because you just don't know what is the right strategy to implement. So I actually didn't make the best first investment. It really was like the cheapest block of land in the closest area to my capital city. And so I just went and bought it. And I got my mate who was a builder to go and build it. And there was just no other thought into it. But looking back on it, although it might not have been the best investment decision, it was still a really, really good investment decision because what it allowed me to do was it just got me into the market. And the fact that I got into the market when I was, say, 19, 20 years old, and now it's been 10 years since I've owned that property, although that property wasn't in the best location and I bought it for around about $550,000, that property now is worth $1.2 million. And I haven't sold it and I still own it. And so, although I didn't implement the best strategy or do the, I suppose, perfect thing, it still has worked extremely well to me. People really need to start, which is just get their foot into the market. And so their wealth can start slowly growing because it's not about timing the market or the right or the correct strategy. It's time in the market, like anything. Like investing and creating wealth takes time. You just slowly keep building up your property knowledge year on year. So, at first it was I just wanted to get into the market. And then the second property, I'm like, okay, well, so how does capital growth work? What's rental yield? And so my second property, I purchased down the Gold Coast with a bit of extra knowledge and I was doing a bit more due diligence and a bit more research. And then I was, learning about rental yield and things like that. So my third property, I brought up in Mount Isa for $100,000. It had a great rental yield of about 10%. And so my journey was just slowly progressing, which was normal investment, bit better of investment, and the natural progression of, I suppose, someone that is really interested in property and really wants to make it their job is just moving more and more to maybe becoming a property developer, a project manager, a buyer's agent, a real estate agent, because they want to make it their full-time job. And so for me specifically, it started off with those small investments and then it worked all the way up to being a property developer, because in my eyes, that was the thing that could create the most wealth in the quickest period of time compared to any other aspect or any other subsection of real estate. And so that was the process. And now I've worked my way up to being a full-time property developer and doing much, much larger projects. Yeah.
For someone listening who's new to investing, what would be the main types of property investments people typically consider? And would you consider them to jump straight into a new development for a first one?
Yeah.
Knowing what you've learned from the first one, that, the teachings that you got out of, building a house purchasing a land?
Yeah, for sure. Look, it's a great question. And it's property investment development. It's like any other, I always say this, it's like any other skill in this earth. You need to walk before you can run. It's like almost saying if you wanted to get into property development, would you go jump in the boxing ring against a professional fighter and see how you go? Probably not, because you'll get your head punched in. And the same thing is with property development. Would you just delve headfirst into a large scale development project? Probably not, because it'll probably bankrupt you. So you always got to slowly learn and walk before you can run. And what that looks like in any regards, whether it's property development or any other skill in this world, is you really need a mentor, or you really need some sort of progression to build up to that end goal, whatever it may be. And, that might look like doing some courses, going to university. You can study property development now. Or for me, particularly, how I learned was just being very, very hands on. So I learned from just going out there and buying property. And that property was slowly teaching me little different aspects of property development. What makes a good investment site? What makes a good location? What makes property prices go up? What do people look for in a property? What is appealing to someone that is buying a property? What's a good like a floor plan? What's the most appealing aspects to a family? Like, why would someone want to buy this property? Because once you figure out all those things, those are all important skills that you use as a property developer. So you definitely need to just walk before you can run, and don't jump into anything that is too daunting or that you can't understand, because property development is very risky. And one project could probably set you back 5 or 10 years if you do it incorrectly.
Yeah. And I think the generation likes to go from 0 to 100 really quick. They want to
Yep.
be retired by the age of 30 or 40 or financially independent. So it's really important, I guess, to what you're saying is education matters. Now, I think
Education is everything.
when I started, yes, I had my mentors, my parents, but I still wanted to educate myself. So I read books, Michael Yardney, who's if you have heard of Michael Yardney,
Yep. Yep.
he
Very
had some
familiar with
great
him.
books. There was 0 to 130 properties in 5 years. I read those, and they spoke about all the different
Yep.
strategies around buying and the different types of investments. And look, I even got stuck. My second purchase was in Kira on the Gold Coast as well, and I bought off the plan. And I worked out a strategy how I could buy a property without actually having the means to settle on the property. It was at the time when property was going through a bit of a boom. So thinking I was able to buy and then on-sell that property before settlement happened. But I got stuck where the GFC had hit in 2008. Next minute, the sale that was on conjunctional,
Through an option contract.
I couldn't get an option contract. The developer wouldn't allow me to go down the path of an option contract because
Oh,
he
yeah.
was thinking, well, have I undersold myself here? This is what he
Uh,
was saying to the agent. So they rejected the option contract. And I went, okay, so be it. And then the agent did successfully find me another buyer, and I was to buy it. I bought my unit, it was a 3 bedroom, 2 bathroom for 650, and I had an
yeah.
option contract at 650. Sorry, 850,000. And I was
Yep.
cheering, but it was in conjunction to the sale of their property. Their property went on the
Yeah.
market. The GFC hit. Next minute, they couldn't sell. I couldn't settle, so I ended up having to forfeit my deposit, which was 32,500.
Sure.
For a young investor, 23 at the time for that second one, it was a
Mm.
lesson. It was a lesson worth learning, and I'm
But that's
grateful.
also a case of luck as well, like,
Yeah,
unfortunate, I
yeah.
suppose circumstances, which is, a bit of it's unlucky.
Unlucky, I see it. Yes, it's unlucky, but it taught me so much. I'm glad
Yep.
I actually made that mistake because had I have pulled it off, I may have gone in deeper
Yep.
on the next
Thinking this
one,
is easy.
thinking
Yep.
this is great. This is the way to do it. But it was quite funny. It was by reading the books that showed me how you could buy property without actually having
Own it.
to own it. And option
Yep.
contracts is like what you said as well.
Which is one of the most important aspects of creating wealth, which I think you can sum it up into using other people's money to get wealthy.
We'll get into that a bit later, Elijah. But for now, in terms of comparing subdivision in terms of risk and reward, what are those risks and rewards that you need to consider when you look at subdivision? Quick word from our sponsor, Rello. Selling one property usually means buying another. And that's where things can get tight. You've got moving costs, legal fees, and then trying to line up a deposit for your next place, all before your current sale has even settled. That's where Rello comes in. Rello gives you early access to the deposit from your current property so you can move forward without the usual cash flow stress. No credit checks, no drawn out applications, just a simple fixed fee with everything repaid seamlessly at settlement through your conveyancer. It's fast, transparent, and built to give you flexibility when you need it most. If you're buying and selling at the same time, Relo makes that transaction a whole lot easier. To learn more, visit Relo at relo.com.au. That's RELLO.com.au.
Yeah, so when it comes to subdivisions or any projects, it really just comes down to your risk assessment. And it's just making sure that you understand all the aspects of the project that you're getting into. Is if you don't understand all the issues that could arise, but all the positives that also can come from it, you don't really know what you're doing. And if you don't know what you're doing, you're just going in there and wishing and hoping for the best outcome. And property development is something that is super, super risky because there's so many things that can derail any project. And that might just come from a simple oversight. You may just not know to check a simple, ecological overlay on the project. And so once you've settled on the site, you realize that most of the site it's unusable. And so when you're going into these large subdivision projects or a large scale property development project, you need to make sure that you've done your due diligence on the whole project. And if you don't understand every aspect of that project, you might go into that project and it might, be worth however much it is. It could be stretching you to your limit, which most first property development projects do for people. And because you've missed just such a simple thing, it might be a flooding overlay, ecological overlay, the topography of the site might be a bit crap. Once you've settled on the site, because it's undevelopable or you can't get the result that you want or you can't sell it, it'll topple you. Because in those first crucial projects, like that first $32,000, usually beginning property developers, they're putting all their eggs in that one basket, and they need to because those projects require so much money and so much capital that it is stretching you. And if you've just missed a simple thing, it's just going to absolutely topple you and it will set you back a very long time. So that's the hard thing about property development is you've got to be a jack of all trades. You've got to understand all the aspects of property development, all the things that can go wrong. You've got to understand that even if you get the development approval, can you sell it? Is this what the market wants? Are you able to sell it? Have you got a real estate agent that is able to market this product and sell it quickly? And so that's why it's very risky and volatile because there's just so many moving parts that can make a project go to crap.
Where do you see new investors misunderstanding land value?
Look, I think, are we talking just the everyday investor here?
Yeah, I think you've got properties on a decent sized parcel, and
Mm.
I feel that some investors just don't know the potential of that block. What could be done to that block?
A property developer just has the knowledge and education of what you can do to a block of land. And I think the traditional homeowner or property investor, they just don't have that knowledge. And what you don't know, you don't know. And so people don't really understand the merits and benefits of having a property that has development potential. And I think that just completely removes that whole idea from their minds. It's too difficult, too hard basket. And so then they would just find themselves investing in normal investment properties, house and land packages, apartments, or even just seeing a buyer's agent, which is completely understandable. I mean, property development, like any other profession, it takes time and you need to put energy into it. And so if you don't have that time, energy, and effort, of course, it's probably in a better situation just to pay someone to go out and go and buy that property. But that really just comes down to knowledge. You don't know what you don't know.
Let's talk about entry level. What does a realistic small project look like?
Look, I think if you were starting out as a property developer, the perfect project to get into is one with little to no risk. Because at the end of the day, all property development is risky. And so if you can minimize that risk almost entirely, then you're going to be in a much better position to actually going through and completing the project. And so what that looks like is I always say to my clients that come on board because I help people find development sites is it's just great to start with a small scale duplex, a triplex, or a 1 into 2 lot subdivision. Whereas you go and purchase the property, you don't actually need to sell the property. You can actually just land bank the property, get the development approval, sit on the development approval. You don't even need to develop it. You can have that experience of going through and getting a development approval. And then at that point in time, if you wanted to sell, you could sell, or you could go and develop it when you're ready. Because those projects are immensely different from what a normal property developer does. because you go and buy a normal property, it's got a normal loan on it, the interest rates are not super high, you're not forced to develop, you don't need to succumb to the market. And so you can really just take your time with that project. Develop when you feel ready and develop when you're financially like you've got the financial capacity to do so. And that was exactly what I did for my first project. Although it was probably on the higher end of things, it was really that. I found a house on a corner block. It was kind of run down, but it was one of the crappiest house on one of the best streets on the Gold Coast. I got the development approval for the duplex, didn't need to do it, but when the time came, I went and I developed that duplex, and I still own that project as well because it was done through normal bank financing. So there was no pressure to sell it because of the financing on the property, and it wasn't too expensive. So that would be my advice to getting into any type of property development project.
And roughly, what kind of capital position does someone need?
Look, it all comes down to the size of the project. Look, for me, for that project, as an example, I needed about $1 million. So that's why I'm saying that wasn't very a small scale one. And I did that project by refinancing 3 of my current properties, and I poured it all into that property. But you don't need that much money. For example, I found a property for a client up in Woombai. It was a $1.14 million purchase price. He put down a 10% deposit. And with that property, you could actually retain the dwelling and you could just subdivide off the backyard essentially. And so he needed, I would say for all up costs, maybe about 10% for that. So that's $140,000, including stamp duty, another 5%. So that's probably another, 60 or so grand. So that takes it to about 200. And for him to actually do that subdivision, it would have only cost about 80 grand. So that's probably almost like the bare minimum that you would really require to get into property development if you're buying and owning, which is probably around about $250,000. But, as you mentioned before, there's many different other strategies and ways that you can get into property development. But then again, it's just adding those layers of complexities and difficulty for things to go wrong. Like that's when we're talking about using option contracts, going out there and taking control of land that you actually don't own, getting development approvals on selling them. But as that just sounds, it's much harder than just going out there and doing it. So there is risk involved with going down that route. So you can get into property development for a lot less money, but higher risk. So there's always a give and trade of it.
That was going to be my next question, is in terms of how people can partner or structure their way into a deal. Is there an example you can give us how you don't have to buy the property yet still control the asset?
Yeah, for sure. So there's that, I suppose, very risk adverse strategy, which is, you could find a buyer's agent or someone like myself to go and source those very straightforward property developments where you buy the land, hold it, you don't need to develop it. And it's risk adverse because you got cheap financing on the property and you don't actually have to develop it. You just need to get the development approval. Another strategy which, you deploy, and it's very common, is using option contracts or even just delayed settlements on blocks of land. So this is something that I do quite regularly now. And what that involves is essentially you're going to go find a property that has development potential, and you're going to make contact with the landowner directly yourself because you need to remove the real estate agent or the middleman. And the reason for that is because if the real estate agent has control of the project, they only are going to have their best interest in mind. So they're going to want a short settlement or they're going to want to sell the property quickly. And for you going down this strategy, you need to completely remove that because you need delayed settlements or time to work on the project to go and get a development approval. And you do that in the regards of using an option contract or a delayed settlement. So that's a type of contract where you can essentially take control of the land. It's just a normal sale of contract on the land, but it gives you the option to go and purchase the land, or if something was to go wrong, you can also exit the project. So it's just decreasing your risks. So the process is find a property that's got development potential, make contact with the landowner, get them to agree to an option contract, go and get your development approval within that option period. And if you're successful in getting that development approval, then you would go and execute the option and go and settle on the property. And it was more so leading into what we were talking before, which is this is the primary strategy that most really successful people use, which is using other people's money to become wealthy. Essentially, you can go out there, take control of land that is not yours, get a development approval on land that is not yours, and then on sell land that is also not yours to another party and take the profit.
Yeah. And another benefit benefit as well with the option contract is it's not changing into your name to the title, having stamp duty savings. Is that correct?
Yeah, well, you can get the development approval, and then you can also go there and go to the open market essentially, or anyone, and say, look, I've got this great project, I've got the development approval, you can buy it, and then it's called they just pay you an option fee. So you can essentially charge whatever you want to go and sell that property. If you've got the property under contract for say $1 million, you get a development approval, you get that uplift, and now you think it's worth $2 million, or a real estate agent does, you can go to that ultimate buyer and say, well, here's the project, it's under contract for $1 million. I want $2 million. They will pay you the extra money. You never settle on the property. You never own the property. And then you transfer the right of the option over to them, and then they can go and settle on the property. So it's a very effective and smart way to go about property development.
Now, in terms of finding a site and buying a site, what due diligence is non-negotiable?
Look, when you're first starting out with property development, or well, even if you're a very skilled property development, having a due diligence period is a non-negotiable. So I would say at least 3 months, depending on the owner. It might be as small as 60 days, but 60 to 90 days is just a non-negotiable, because you need to check everything within inside that property to make sure it can do what you think it can do. So you can't go into any property development deal without having due diligence. Another non-negotiable when you're starting out is, I would say, a delayed settlement. Almost all starting property developers, even myself, if the homeowner didn't give you that delayed settlement, you just don't have the resources to go out and settle that property, or even get the development approval on the property before settlement. And so you're pretty much screwed. And so starting out, you really need to find that gem, or that needle in a haystack, where you found a property owner that is willing to give you the time to get the development approval, as well as that due diligence period, which there are homeowners out there, and you always compensate them for their time by giving them extra money and stuff like that. But I would probably say those are probably two of the most non-negotiable items for a property developer starting out, because you've got so many ways out within that 2 to 3 months of the due diligence period. Let's just say you stumbled across something that you didn't notice before. Sweet, you can exit the project. If you've got a delayed settlement, say up to a year, and you're going through the process where, in a worst case scenario, you've ran out of money, again, you've been blindsided by something, one of the investors that you've brought in on the project, that might have been a financial partner, pulls out, something goes wrong, it's not going to be the end of the world, because you have the option to purchase it, the right to purchase it, but you don't have to purchase it. And so you can exit. And so that, as a risk assessment, is probably the most important thing starting out to do.
And what would make a site attractive for subdivision?
Look, the most attractive thing to a subdivision is just land size. Um, Generally speaking, if the block is a very large block, and it's in any close proximity to a town, a city, or a CBD, at some point in time, it might not be now, that property is most likely going to be developed just through the expansion of the wider community. And that's why a lot of, I suppose, passive property investors and property developers will just sit on large blocks of land. And even if you don't know much about zoning and things like that, it's only a matter of time before most properties do get developed. Now, I wouldn't recommend it in that sense. Like, if you've got the skills and knowledge to go and look at all the issues with a site, I definitely do that. But by simply just sitting on large blocks of land for a long period of time, generally speaking, is a very good investment strategy.
And how do you assess zoning and council appetite for subdivision?
Yep. So look, the simplest way to answer that question is just by having a really good town planner. So a town planner is, I would give you the analogy as your lawyer when it comes to property development. So a town planner is someone that has went to university, got a degree, and they've studied how town plans work, planning policies, what council require, and all the legal legislation around what you can do with property. It's essentially, their job is a lawyer type of job, where they understand rules and the legalities around property, and they would go and study that, and they're a professional in it. So if you're wanting to know what you can do with a property, the best thing that you can do is just go to the professional. Go to a great town planner, and that person would be able to tell you the ins and outs of what you can do with that property. That would be the easiest and primary way to do things. But alternatively, if you want to go teach yourself, Another really good tool that you can use is just by calling up the local council. Usually local council have, a free service where they've got town planners on call, and you can call up your local council and go, hey, look, I own this property. I'm interested in this property. I'm looking at doing X, Y, and Z to this property. What are your thoughts? And usually they do have a free service where that town planner will just give you some general insights, what you can and you can't do. And then, I suppose going more deeper into that, if you want to teach yourself, it's really just, I suppose, going through that journey of becoming almost like a junior town planner yourself. A good property developer is also, a bit of a town planner. They know what you can and you can't do with land. And so what that looks like is just by slowly, maybe even going to university, doing courses, or just self-educating yourself, how town plans work, how to read, the interactive mapping, reading the planning policies and what you can and can't do with property.
And in terms of the numbers, obviously the numbers are important. How do you think about feasibility and margin buffers into a project?
Yep. So great question. Other than understanding what you can and you can't do with property, I think probably even more so important, or just as important as that, is just knowing your numbers. And this is one thing that I can't go on about enough, because there's so many beginner property developers that message me, and they show me this beautiful project, and I'm like, what's the feasibility look like? And they go, what's that? And I just think to myself, I'm like, you don't even know what you're doing. Because if you don't know what your numbers are, you don't know the profitability of the project. It might be something that is going to not only cost you money, but it might sink you. So understanding your numbers and understanding how a feasibility study works it's a non-negotiable in property development. And understanding how feasibility studies work and how to put them together, it's a real skill, and it takes a lot of time. And that's what will tell you the risk profile of the development, but also allow you to put in those risk buffers into the feasibility project. And they are essential to have, just as general numbers. You always really want to make sure that a project has got, a 20% profit on cost, which is more terminology that property developers use. And that's also making sure that you're getting the feasibility study right. Usually, generally speaking, excluding GST, depending on how the property has been settled, because GST and those margins can really blow out feasibility, studies. And what I mean by that is when you're in the, I suppose, business of property development, where you're buying stock and you're selling stock, you're liable for GST. So the general property market doesn't really include GST into their sales, because if a property is for sale, say for $10 million, there's no GST really aspect of that. It's more of a commercial terminology. But you as a property developer is someone that needs to account for that in their feasibility, or make sure that you're not accounting for it in the aspect that it's adding to your end margin. Just an oversight of GST is a 10% margin on what your end sale price could be. If you're selling a property for $1 million, you haven't included GST, that property is really only $900,000, because $100,000 has got to go to the government. And so all of that ties into, I suppose, the risk assessment and having those margins and having, buffers and contingencies, like 5% contingencies. But that really all comes down to one primary thing, which is understanding how a feasibility works, understanding how to build one, and also understanding all the moving components in the feasibility.
And let's move into the growth phase. You've just done a duplex and it was a successful one, and you want to transition from a small subdivision to a larger scale development. What changes when the numbers get bigger? Is anything changed, or is it fundamentally the same, or?
The main thing that changes is your mindset. So with my journey and how I see things in the world now, is the most successful people in the world get to where they get to because they can think big. That's really all it is. If you are able to think and conceive ideas much bigger than what you thought was achievable, and you go out there in the hopes and with the confidence or even just the courage to go and try to get it done, you're going to always be more successful compared to that person that is always taking the very risk adverse and easy path to any endeavor in life. And what I mean by that is, my first real property development project was this duplex, and it was a really nice duplex. Like, it was a very high-end project. Upon completion, it was worth around about $5 million, and that was maybe about 2-3 years ago. The project's worth about $7.5 million. So it's a big project for your first project. But that, in comparison to what I've just pulled off now, is minuscule. So my next project, which was just exact like the following project was a 267 lot lend lease community and over 50s community in more of a rural town. And that project has an end value of about $200 million. And how that really came about was with one, primarily having the right mentor, but two, also just knowing and thinking bigger. Because if you can't sort of even comprehend how the bigger guys work or what is possible out there, you're never really going to go and try to go and do it or go and execute it. And so you've really just got to think and believe within yourself that anything is possible, really. And if you have that, I suppose, courage, you can go and achieve things that are far greater than what you could ever think of, just purely from the fact that you think and believe it's possible, which is an amazing thing.
And in terms of transitioning from the duplex to a bigger project, like you just mentioned earlier, did you find that your team evolves around you, your support network, and how does the capital structure evolve as well once you start to go into these bigger projects?
So everything around you involves because when you get involved into these bigger projects, essentially you're doing the same process compared to much smaller projects, but the planning documents, the work and effort and energy required to get them approved is much greater. Using in an ideal world, the best consultants, like to get that project approved, it took me 1 year just to get all the documents required to go and submit the application. And so it was about 1,000 page development application. And so for me personally, I went to all the best consultants, I went to all the best firms. I got the most comprehensive and put together development approval application. And in that process, you're meeting a lot of people, you're making a lot of connections, you're learning a lot about the industry itself. And you realize when you get into these bigger projects, funnily enough, in a sense, they're a much easier thing to get approved because you're no longer playing with the small fish where you're a mum and dad property developer, you're looking at building a duplex, triplex, things like that, and you're actually filling a community need. So you're going out there and you're realizing that there is issues in the wider community, the wider economy, and your job really at that stage is you're solving an issues. You know, with that particular project, I was solving the need and requirement for the aging population for the over 55s. It was the first project of its kind out in the Lockyer Valley. And because the Lockyer Valley Council knew that this was required development, it actually flew through council. And so this is a learning curve that, I've just went through, which is you're playing a different game. You're no longer playing where a game where, the neighbors are going to be kicking up a stink because you're building a nice house next to them. And, might be seen as this, I suppose, like a property developer that is just driven by greed and things like that. And you're more so seen as a person that is really solving a community need. And so the conversations that you're having around the property and the property development is entirely different. Councils are very supportive of it. The consultants, that you're dealing with are very sophisticated. They're used to dealing with these projects. They're very professional. The team and people that you're building around you is insane because it's essentially, you're in a space which is very, very niche and you're supporting a community need. To be honest, it's a much more enjoyable place to be in. And so you're growing massively as a property developer. I've just been invited up in Brisbane to go meet with some, local council members, members of parliament and things like that, because essentially now I'm trying to tackle larger and larger projects that are really helping the issue of the housing crisis in Australia. And so those types of conversations and rooms that you've been put into is immensely different. Immensely
Yeah.
different. Well, look, it's the same risk as the smaller projects in the sense of that if you get these projects wrong, it will bankrupt you. The project that I've just got approved, and although, I'm thankful it was a successful project, I'd done all my due diligence. If I got that one wrong, it would have bankrupted me. So it would have put my whole property development career back maybe about 5 years. And that's more so for the bigger projects. So the bigger the project, the more risks. More money, more problems. So when you're getting involved in these bigger projects, it's just higher stakes. If you're to get it wrong or something was to go wrong, it's not really a $32,000 mistake. It's not a $100,000 mistake. It's, almost tens of millions of dollars of mistakes. And, you make a mistake even with someone at my position in my career, it's still going to bankrupt me. And so each project that I am sort of moving on to now, I'm very scared and very timid of because I know the potential of if I get this wrong, what's going to happen. And I think that is very true for even elite level property developers. It's something that is always just in the back of your mind.
Now, you've got a business and you support others who want to get involved into development or
Yeah.
subdivisions or investing in real estate. What's the biggest win so far for one of your clients?
Well, yeah, there's heaps of them. When I was first starting out my business, my first clients were my best friends, surprisingly, because they saw how good I was doing in property and they wanted to recreate that for themselves. And so my first 10 or 15 clients, because I run a buyer's agency as well as a consulting firm, was my best mates. And I think for me personally, those have been my biggest wins. So, I've purchased countless properties for all my close friends. And I would say, I did a bit of a portfolio review on, I think it was about 6 or 7 properties that I purchased literally for my best mates. And all of those properties have went up consecutively about 15 or 16% per annum, which is huge in the property space. In the property space, you're hoping for a 5 to maybe 8% return per annum. And so I've exceeded that. And seeing my best mates have wins in properties is such a rewarding thing because, you've got a very personal connection with these people and seeing them have very big wins in property is massive. And these wins they're nothing too crazy, but I'll give you a couple examples. I purchased a property for one of my best mates. His name's Anthony. We bought it in Burley Waters for $1.14 million just last year. And in 1 year, that property's went up $250,000. And so it's about a 22% increase. And $250,000 to anyone is life changing. It truly is life changing. And knowing that I've done that for a really good mate is amazing. But look, it's not just for close friends that I've had those really, really good wins for. It's for clients as well. Like that other property I was telling you up in Mumbai, it was a 1 into 2 lot subdivision. It was a client that reached out to me. He found me through social media. He wanted to get into property development. He knew nothing about property development. And so he, engaged me as a buyer's agent and I got him the perfect deal to start his property development career, which is such a powerful thing for anyone to get into the space, which is a low risk development. He's getting the development approval for the 1 into 2 lot subdivision, and just it's more of a satisfaction thing knowing that I'm helping these people get their career started or helping their financial journey. It's more satisfying than the money that they pay you, but the wins are countless. I've got too many.
Yeah. And in terms of someone who wants to engage with you, what's the journey from the beginning? What does it look like?
Yeah, for sure. So look, it's a very simple journey with that side of my business because I've got my two primary business, which is one's a buyer's agency and a consulting firm and a project management firm, which is that keeps the money coming in, and the other side is my property development arm. And so when I have a client that's coming in for, I suppose, services for to buy a development side or a property investment, I've got both skills of a buyer's agent and a property developer. But the process is quite simple for the client. Essentially, they'll inquire, we'll have a consultation session, we'll see exactly what their goals are, what their long-term vision is, what they want to achieve, why they want to achieve it. And then realistically, what happens from there is once I understand what they want to do, I will explain how I can help them if we're a good fit for each other, and I'll sign them up. They'll become a client of mine. And depending on what their goals were, if it's a property development, if it was a normal investment property, we'll go out there and source the property for them. And then we'll help them through the whole process through negotiations, through settlement, we're helping with solicitors and things like that. And, again, if it was someone that was wanting to get into the development space, we even come on as a project manager and we'll go and project manage that whole project from start to finish, which we're doing with clients right now. And along that journey, hopefully you're working with someone that's willing to teach you along the way. And so that although you'll be paying for a fee, that fee is very minuscule to the knowledge as well as the execution of what that person might teach you and do for you.
And what is it when you talk about fees? What's the fee structure like, Elijah?
Yep. So look, general buyers agents, the fee structure is very simple, depending, I suppose, on the scope of work. Buyers agents are anywhere in the realm of probably about, I'd say, $15,000 to $25,000. So for me, I'm on a bit more of that higher end, just purely for the fact that I'm bringing that wealth of knowledge into the investments that I find for clients. Development potential, things like that. For me personally, with how I run my company, is whatever the fee may be, say $20,000, there's an initial fee paid up front to engage the buyer's agent. So it's almost like a commitment fee. And then the other half of that fee is paid upon settlement or upon the contracts becoming unconditional. So it's quite a simple fee structure. Half's paid up front, half's paid upon settlement. And yeah, it's a pretty straightforward process.
And if someone's listening wants to move forward and, from thinking about investing and actually doing something, what's the first practical step they should take?
Look, the first thing that you want to do is you obviously want to do your research into who you might bring on as a buyer's agent, because there's a lot of clowns in this industry and there's a lot of people that say they have done and can do things that just have no idea what they're doing. And this is very true with social media and even the internet as a whole. Don't take everything that you see real and see it as face value, because if you choose the wrong person to go out and find that property for you, like I just said, it will set your career back, a potential couple years, depending on how bad the decision was. So make sure you go out there, you do your research, you read customer reviews, you see if they've got an established company and business and they've got credibility, they've actually done exactly what you want to do. Make sure if you ever see someone and you want to do something, make sure that that person has done it and make sure they've truly done it. So just do your research, do your own due diligence, who you invest in. And when you do make that decision, make sure you meet with the person that is actually finding the property. Don't meet with the person that is the boss and you'll be, handed off to an employee that's learning the ropes. Meet with the person that is going to find the property. Make sure you trust them. Make sure you understand who they are and ask them questions, and make sure that you feel comfortable with going ahead with them.
Elijah, I really appreciate you coming on Off Market, mate. Thank you very
No worries.
much. Thank you for watching this episode. Don't forget to like, share, and subscribe.